Hi, everyone. I'm Kristin Donnelley, advisor with the Learner Group. Well, tax season is officially here, and with it comes a wave of new tax changes from last year's signing of the One Big Beautiful Bill. Out of the 39 changes that happened, we are going to take a handful of them and review them and to talk about how these might be possible deductions or tax savings for you. So let's take a look. To help me describe some of these changes, we have estate planning attorney and CPA, Wayne Cooper. Hi, Wayne. Thanks so much for joining.
Thank you for having me.
Yeah, absolutely. And so, as we were preparing for this yesterday, we discovered together that there is a lot of confusion around the One Big Beautiful Bill tax changes, a lot of misunderstanding. So, I think this is going to be really helpful for our clients and prospects to know a little bit more about these changes since we're now ready to get going on this season. All right. So what we're going to be talking about is we're going to be talking, first of all, about, people who itemize and people who take the standard deduction. We're going to describe that a little bit. You're going to kick that off. And then we are going to talk about the new SALT deduction increase, senior bonus deductions, some charitable deduction changes, car loan interest deduction, overtime tips and pay, and qualified business income deduction. And so, we're just going to review some of these and talk about, some of the details around them, because, you think you understand it, but not really. It's important to note that some of these deductions are permanent and some of them are temporary. So you have a window of time to take advantage of actually most of these. So,
So, Kristen,
yeah.
before we get into these details, one of the things I wanted to point out is that a lot of these changes, the benefit depends upon whether you are whether you itemize your deductions, which
Hmm.
means you have deductions greater than the standard deduction, or if you just claim the standard deduction. Now, in the past, we used to talk about above the line deductions and below the line deductions. Above the line deductions would be deductions that reduce your adjusted gross income. And adjusted gross income is an important number because a lot of limitations and phase outs are based upon your adjusted gross income.
Hmm.
In addition, some states like Illinois, they start with adjusted gross income in determining your state income tax. Below the line adjustments used to mean really just itemized deductions
Hmm.
and what itemized deductions you could claim. Now we find there's a different category where there are deductions that are not itemized deductions, but do not reduce adjusted gross income. And we'll point those out as we get to each individual topic.
Yeah. And one of or two of the things that people might be familiar with, that the AGI above the line deductions can impact is, for example, the additional payments that you need to pay for Medicare. So that's one. And also above the AGI also dictates whether or not you can contribute to like Roth IRAs. And so that's an important number. So it's just interesting that these deductions don't necessarily affect that. So, all right, so let's start with one that probably most people have been hearing about in the news for years now was this SALT deduction increase. So before 2018, there was unlimited SALT deduction. And what is SALT deduction? State and local tax deduction. Now, Wayne, before you start talking about the details of this, did that include like state and local tax for second properties, third properties, or was it just your primary home? How did that work?
So state and local taxes include income taxes and real estate taxes.
Mhm.
Okay. There are some other taxes that might be included, but not many states have them, like a personal property tax, or sometimes if you don't have a state tax, you're allowed a sales tax deduction.
Okay.
Okay. Um, in the past, as we said, those were unlimited. Taxes are a broad deduction.
Mhm.
So it doesn't have to be related to your personal residence or your second home. It's just real estate taxes that you pay. Interest is limited to residential interest generally, and that would include your primary residence and a second residence. But that concept is not applied to real estate taxes.
Okay.
Yeah.
Okay. All right. So this is a temporary deduction, only available starting this year's tax return. So from last year to 2029. So describe what it was before and what it is now, and then we'll look at an example.
Okay. So this limitation was put in, well, for a lot of political reasons, but it limits your itemized deductions for state and local taxes to $10,000. Now it's limited to $40,000. In higher taxing states, Illinois is a good example. Most people's real estate taxes are over $10,000. So they didn't get any benefit from the income taxes they were paying to the state. So one of the big issues in passing the bill was whether the SALT deduction was going to be increased or the limitation removed completely.
Mhm.
And they settled at a $40,000, well, an increase to $40,000, so a $30,000 increase. But it phases out for people with incomes over $500,000.
Mhm.
So even though you have the higher limitation, you might not get the full benefit if your income is too high. As we started, this is one of those, this is an itemized deduction.
Mhm.
Okay, so this would be reported on Schedule A, where you list all your itemized deductions, and then you compare that with the standard deduction, and you take the one that's more beneficial.
Mhm.
Now, we have an example here just to illustrate. If you have a couple with a taxable income of $200,000 and they have state and local income taxes totaling $50,000. Okay, so that is a potential savings at that income bracket of $8,500 because that would be the excess above the standard deduction. Now, this example assumes that they had no other itemized deductions. But clearly, if, for example, you had residential interest and you had charitable contributions, which are itemized deductions, which totaled more than 31,500, then the benefit from the new SALT increase would be the full $40,000. And at 22%, that would be $8,800 savings. So it can be quite significant.
Yeah. The SALT deduction is just one of the few itemized deductions. It's just one of them. There are other itemized deductions, the mortgage interest and other deductions that you could take. So this is just one of them, but going up to $40,000, can be really significant.
So before we move on, I wanted to point out one thing. A lot of the high taxing states enacted legislation that allows pass-through entities to
Mhm.
deduct the state income tax. And the purpose was to get by the SALT limitation,
Oh,
at least with respect to the taxes paid for the entity. We're not exactly sure yet how the states will react to this higher limitation, but you should always check to see if you have a past serenity like a partnership, an S corporation, or a limited liability company. You want to see if they made the pass-through election, because it would give you some benefit of those deductions, even those above the limitation.
oh, okay. Oh, that's good to know. Okay. All right, a new deduction, the senior bonus deduction. Now, this is the one that you see on the news or on TV where they're talking about, or you might read about, where it is eliminating income tax on Social Security benefits. That's this. And it actually doesn't have anything to do with Social Security benefits. It's actually just for people who are 65 years and older. So it is a deduction just by having, by age. But there are phase outs. So can you describe how this one works, Wayne?
Sure. So each taxpayer over 65 gets a $6,000 deduction. So a married couple would get a $12,000 deduction. And this is one of those new deductions that are, we would normally think these were above the line deductions, but this is one where it's below the line, but it's not an itemized deduction. It's just an additional deduction you can get in going from adjusted gross income to taxable income. Now, the important thing here is the phase out. So the benefit is reduced by $60 for every $1,000 of excess above the limitation. So in my senior couple, if they had $100,000 more than the limit, which would be $250,000 total, they would fully lose this new credit, or excuse me, new deduction.
Mhm.
So in this example, the senior couple with 150, because they're not at the phase out level,
Mhm.
they would get the full benefit, and at that income level, they'd be in a 22% bracket, and the savings is just short of $2,500. But
Yeah,
again, as Kristen pointed out, there's no relation to this to Social Security.
right. And this is another temporary deduction. So, from 2025 to 2028. So hopefully you are 65 and older um, as of this year, then you can take advantage of this. Okay, one of the two charitable changes is this new charitable deduction for non-itemizers. So people in the past, you had to itemize in order to get this charitable deduction. This is for people who don't itemize. And this shows permanent. So explain how this works, Wayne.
Okay, so this is an additional $1,000 up to $1,000 deduction for each taxpayer for cash donations to public charities. Okay, so a lot of people will donate appreciated securities because of the advantage of not paying the tax or any gain on the appreciation, but those would not qualify for this. So this would be cash donations, like the checks you might write to your church, or to any charity that you support with a cash donation. This deduction is only available to those who use the standard deduction. So once you get over the limit, then you claim the standard deduction and you lose that extra 1,000. This is not subject to phase out. Okay, so it's not, it doesn't
Depend on your income. Doesn't depend on your
depend
income.
on your income. Thank you. So in our example here, we assume a couple with $160,000 and they give $2,000 to their church. And you could see that they get a $440 tax savings.
Mhm.
Okay. Again, you can't itemize and get this advantage. Okay.
And if you have a donor advised fund, or
A private foundation.
private foundation, you can't contribute to those. So it doesn't
Correct.
count towards those.
Correct.
Okay. All right. Now, the second charitable deduction change is also permanent. And this is, well, why don't you describe this? Where we were before and what it is now.
Okay. So charitable contribution deductions have been limited based upon your AGI and the type of property you contribute and the type of entity that you contribute to. So, for example, cash contributions to a public charity are limited to 60% of your adjusted gross income. This is a totally different type of limitation. It's in addition to those percentage limitations. And what has been done is they've added a floor of 0.5% of AGI. So, for example, if your AGI was $1 million, you would not be able to deduct the first $5,000 because that's 0.5%
Mhm.
of $1 million. Okay. This is very similar to medical deductions, which for many years have been limited to the excess of 7.5% of your AGI. But in addition to this floor, they've also put a benefit ceiling in. So if you're in a higher than 35% tax bracket, your deduction is going to be limited to a 35% benefit. So you will not get that extra benefit of the 2% higher tax.
Mhm.
Okay. Again, this only applies to itemizers.
Mhm.
If you use the standard deduction, this does not apply to you. But if you make substantial charitable contributions each year, this could be significant. And I would always say with charitable contributions to always consult your tax professional when you're thinking of making a large contribution so that you can determine which year you might want to take it and whether you want to combine certain years in order to get the highest tax benefit from the contribution.
Yeah, that's a good one. Okay, so this is an interesting one. It benefits people who buy new American-made cars. So it's probably intended to help people, maybe juice the U.S. automotive industry and put a little bit more money in the pockets of the people who are buying the cars. So this is a temporary from 2025 to 2028. And so describe this to us. This has some phase outs and doesn't have itemizing requirements. So explain this one to us, Wayne.
So this is a nice new deduction for people who buy cars and borrow money because they pay substantial interest that years ago was deductible. All interest was deductible, but they basically limited the deduction to residential interest or investment interest. So this type of personal interest wasn't deductible. So you get to deduct up to $10,000 of interest paid on a loan to purchase a vehicle that is assembled in the United States. So if you're looking to buy a car and this is an important deduction for you, you need to ask the dealer or check online to make sure your car has enough activity and assembly in the U.S. to qualify for the credit deduction. Apologize. Again, Kristen, this is it gets phased out. So the beginning of the phase out for single is $100,000. The beginning of the phase out for married is $200,000. And then you're fully phased out at 150 for single or 250 for married. This is one of those new deductions where you don't have to itemize, but it does not reduce your adjusted gross income.
Okay, so let's go through this example. I know you didn't like my example yesterday, Wayne, because of, but I just think it illustrates the point of how much it can save somebody if they are buying a very expensive car.
Yeah. My question regarding the example is $10,000 of car interest in 1 year would buy a lot more car than somebody with 100,000 of income should be driving. But that said, we just wanted to illustrate that the income is below the phase out, so they would get the full $10,000 deduction. And again, that would put them in a 22% bracket, so the tax savings is $2,200.
Perfect. All right, now I've combined these two because they have some similarities, and I wanted to hit them both because they've been in the news so much. Overtime and tips pay deduction, or what you see on the news as no tax due on tips or overtime. Again, it's not quite that, but it does have to do with tips and it does have to do with overtime. So, why don't you explain first overtime, Wayne? Again, it's a temporary deduction.
So the overtime deduction is only for the premium that you are paid when you work overtime. So federal law in a lot of cases requires time and a half for overtime. So it would only be that half additional that you're paying that would qualify for this deduction.
Mm-hmm.
Now, this deduction is phased out at the income levels you see there, 150 for single and 300,000 for married. Now, we list that it's only for non-exempt employees. Exempt employees earn a salary and they do not get paid overtime. So only employees that would get paid additional payment for working late would qualify for this. And this is like that. These new deductions where you don't need to itemize, but it does not lower your AGI. Now, one thing I wanted to point out in both of these new deductions, even though they're not subject to income taxes, they're still going to be subject to payroll taxes. So you might have to pay Social Security on these amounts.
Okay.
And then tips, if you receive tips as part of your earnings, you can deduct up to $25,000 per year.
Mm-hmm.
And this would cover both exempt and non-exempt employees. So it doesn't matter if you work for an annual salary or if you work on an hourly basis.
Mm-hmm.
And our example really takes care of the just the overtime, but it shows it can be quite significant, $3,000 savings in 1 year.
Yeah. Okay, so basically there is a limit and there are phase outs about this no tax on tips, no tax on overtime. It's not really that. It is a deduction and there are limits to it, but still can be pretty significant for those who it would apply to. Okay, now qualified business deduction. So Wayne, why don't you talk about this? This is now permanent. That's the change of this. This is what it was. These were the details of it before, but it wasn't permanent. Now it's permanent. So describe this. This is for small business owners. Is that right?
Correct. This is for small business owners, and it allows a 20% deduction for the net income from a qualified business. Okay. It applies to sole proprietorships. It applies to S corps, partnerships, limited liability companies, so any flow through entity. And basically, you would compute the income from that entity. You would make some adjustments because to the extent you make, if you have a self-employed health insurance deduction, or if you make a self-employed pension contribution, that would go into computing the 20%. But this deduction was scheduled to expire at the end of 2024. So putting this back in, very helpful to the small business owners. And this one, again, is one that you don't need to itemize in order to take the deduction. But again, it does not reduce your adjusted gross income. Okay, so it's one of those odd deductions that are quasi below the line.
Yeah, but if you can take 20% deduction of your income from a small business, that could be really significant. So this is a good one.
I was looking at that very closely, just for personal reasons, because I work through a small business.
Oh, yeah, perfect. All right, so these are, a handful of some of the changes in the tax code as a result of the passing of the One Big Beautiful Bill last 4th of July. But there are actually 39 changes. And so if you want to look into other changes that were a result of this bill being signed, you can go to irs.gov under One Big Beautiful Bill provisions, and you can see all of the changes that were made. And also, if you think some of these apply to you, then we encourage you to talk to your advisor or your CPA, or they can coordinate together, or all of you can coordinate together to see how you can save money. Wayne, thanks so much. I think it was really helpful. I learned a lot in this presentation, so I hope our clients and prospects did as well. Thank you so much for joining.
Thank you.
Okay, take care, everybody. Thank you. Bye.